All of the problems covered in my videos can be downloaded at accountingworkbook.com. If you go to the website, click the PDF link, you can download a copy of the workbook for yourself. Also on the website, you'll find links to all of my accounting videos, not just the ones I've uploaded to YouTube. I've uploaded over 100 extra videos on this website that you can't find on YouTube. So I do hope you'll check out accountingworkbook.com. All right, let's begin our problem. Let's take a look at problem 10.1a. This problem has us recording a bunch of journal entries related to equity transactions. In part 2, I think I'll break this into 2 parts. In part 2 of this problem, we'll prepare a statement of changes in shareholders' equity. So quite a lot to be done, and we haven't really looked at equity. It can be a tricky topic. I think this is a relatively straightforward problem as far as equity stuff can go, but equity can get quite complex at times. Okay, so the December 31st, 2016 shareholders equity section of Bossman Inc.'s balance sheet is shown below, and there is their shareholders equity. They've got some preferred shares, some common shares, and retained earnings. Now, something that we haven't discussed so far is preferred shares. We haven't discussed it at great length, but one of the features, when I was a kid growing up, I always thought, oh, preferred shares, those are the ones I want because they're preferred. Well, really, when you're investing in a company, you're looking at investing in common shares, but the feature of preferred shares that makes them attractive to investors is they often offer a guaranteed dividend, or at least they get dividend preference. And the dividend is so important to preferred shares that, in fact, it gets stated as we list our shares. So this is a $10 preferred share. It doesn't mean that we pay $10 for our share. That's not the par value of the share. That is the dividend amount of the share. So just keep that in mind, that these guys, if you own a preferred share, one preferred share, you get a $10 annual dividend. The fact that it's non-cumulative isn't going to be relevant in this question, but a cumulative preferred share means if they miss the dividend one year, they got to pay you last year and this year. You know, they gotta catch up if they miss a year. Okay, common shares 20,000, retained earnings. Okay, so common shares and retained earnings. There's not much new there. The following equity transactions occurred during 2017, and you can see there's like 6. That for like a typical privately held company, that would be a ton of equity transactions. Most small, businesses will have 0 equity transactions of the year, maybe a dividend at the end of the year, but you can go years and years without an equity transaction in a small business. But anyway, we're learning about equity transactions. We're going to do a few equity transactions. So the first one, issuing common shares for cash. Well, issued 5,000 shares for $12 each. That's $60,000 worth of shares, just 5,000 times 12, and we got that amount in cash. So let's debit cash for $60,000, and that was on January 31st. We'll credit common shares because our shareholders' equity grew. And again, students that are shaky with journal entries, this is the one that trips them up. They think, oh, debit common shares because there's more common shares out there. No, common shares are a measure of equity, and equity is growing because people are investing in our company. So we credit common shares to signify that equity is growing. Again, a lot of people get in that mind, debit is plus, credit is minus, and that's just not the case. Okay, let's move on. The next entry, May 14th, issued 100 preferred shares in exchange for equipment, not for cash, and the equipment has a fair value of $90,000. Okay, so May 14th. What did we get? Well, we didn't get cash. We got equipment. If the value of the equipment is $90,000, and that's a fair value, we will say, well, then you get $90,000 worth of preferred shares. And that's 100 preferred shares. Now, the number of preferred shares doesn't really matter to the value. Obviously, in reality, it matters to the value, but it's not like I'm doing a calculation going, okay, well, that's 190,000. That's $900 a share. And I look at my other preferred shares, and they were maybe at a different valuation. That doesn't matter. to this entry. July 1st. Declared the regular cash dividend on preferred shares. Well, what was our dividend on preferred shares? Our dividend was, we said we are going to pay a dividend of, oops, I got to go up higher, $10 per preferred share, and there's 500 out there, except for we've just issued 100 more. So there's 500 plus 100, there's 600 shares out there, and we're going to pay $10 for each one. So that's $6,000 in dividends. So when we declare, it means we've promised to pay. It doesn't mean we've paid, right? A declaration is like a promise. It just means we've promised to pay. So we're not going to credit cash here. So this entry is a little bit new for us and actually represents a bit of a change. When we get into the equity transactions, the way real companies record dividends, at least in my experience, is they don't debit an account called dividends. That's what we did in chapter 2 and chapter 3 when we had dividends. We just went debit dividends. Real companies typically debit retained earnings directly because we said, oh, it flows through dividends to retained earnings. In my experience, a real company will just debit retained earnings directly. Now, again, if a student in my class debited an account called preferred dividends here, I would not mark them wrong. I think they're totally fine. But in my experience, it's just a direct dividend to retained earnings. And the amount of this dividend, as we said, was $6,000. Our credit isn't to cash, it's to dividends payable. And in this case, preferred dividends, sorry about my writing there, payable, and that's for $6,000. Okay, now we pay them. So on July 15th we pay them. On July 1st we declare. On July 15th we pay. So how much do I pay? Well, I pay $6,000. Now cash changes hands, and I can debit preferred dividends payable, right? I can say that liability is no longer a liability. I will have paid it. One more entry to look at. August the 7th, declared and issued a 20% stock dividend on common shares at a time when the market price was $13 per share. Okay, so a stock dividend means we're paying people, but we're not paying them with money. We're paying them with our own stock. We're saying, here, have some more shares. Okay, let's think about what this means. Well, let's date this. August the 7th. Our first step here is to figure out how many common shares are there existing in the world. There's 5,000. There's 20,000 plus we've issued 5,000 more. So there are 25,000 preferred shares. 20,000 plus 5,000 means there's 25,000, or not preferred, common shares issued and outstanding in the world, right? There's 25,000 common shares out there in the world. We're going to declare a 20% stock dividend. So let's just take 20% of those common shares, and that's 5,000. So basically what that means is if you own 5 common shares, excuse me, I send you 1 common share. So if you own all 25,000, excuse me, I'm issuing you 5,000. Like I'm issuing 5,000 new common shares to send out into the world. So 5,000 common shares to be issued. That's what this means. That's what a 20% stock dividend means. So 5,000 common shares are going to be issued at a time when the price is $13 per share. So that means that's $65,000 worth of common shares going out into the world. $65,000 worth of common shares going out into the world. So when $65,000 of common shares go out into the world, we credit common shares to say those shares are being issued. There's more equity out there in the world. And we debit, as I suggested before. Normally I might say here debit stock dividends or share dividend. That's what I would say in the old way of thinking. Here, though, I'm going to debit retained earnings directly, $65,000. Okay, we've recorded our transactions for the year for this company. In the next video, we're going to prepare a statement of changes in shareholders' equity. Stay tuned.